Hey traders, this is Blake Morrow with Trader Summit, and I have with me the day after Thanksgiving, the U.S. Thanksgiving holiday, Jim Welsh from Macro Tides. How you doing, Jim? Good to see you.
I'm good. I'm recovering from the food coma. So
Yeah, as we all are, I think. Those of us
Yeah.
in the United States, not everybody everywhere else, but
Right.
good. It's good that it looks like you're recovering well. So it's been a wild week actually, and we got a little bit more move this week based on the FOMC meeting minutes. Really striking the market is dovish, and it was interesting because going back to the Fed meeting from a few weeks ago, we had a knee-jerk reaction as the market originally read the FOMC as being a little bit more dovish, and then obviously Powell came out and kind of smacked that down with his hawkish comments. But here we go again. The market's kind of well bid. The S&P is getting close to the 200-day moving average, and how do we interpret all of this, especially with the last meeting of the year coming up in just a couple of 2.5 weeks? How should we be reading the markets here?
Well, it's kind of a continuation of a process we've seen all year, where the FOMC and Powell says, this is what we're going to do. And Wall Street, for whatever reason, chooses to not either believe them, like in the spring when they said they were going to go to the neutral rate, August, where it was like, oh yeah, we're in a recession already, so the Fed's not going to have to raise as much, and then they'll be cutting. And now, Powell basically clearly said it isn't how many rate increases that matter right now. It's the destination and how long we hold up at that level. And so what we're seeing, Blake, is just more of the same. The street wants to believe that the Fed going from a 75 basis point increase to 50 basis points represents some kind of an easing or pivot. In my opinion, it's a ridiculous notion, because the key point that Wall Street's missing is the Fed is going to get to that, whatever the number is. Is it 4.5? Is it 4 3/4? Almost that's secondary. Their intention is to hold it at that level, at least on paper, all through next year. And what that also means is that as they do that, we're going to see the catch up in terms of what happens to the economy as the full brunt of the increases that we've seen so far over the last 7 months really starts to impact the economy. And in the short run, as that happens, the Fed isn't going to immediately back away. So that, to me, is the other shoe that's likely to drop sometime in the next handful of months.
Yeah, I mean, obviously, the way the economy embraces, I guess is the word I'm going to use right now, embraces all of this is going to be interesting. So the first chart you brought up today, Jim, is the Taylor rule, and so what does that tell you about? Are we restrictive enough? Is that what you're trying to explain to us here?
Well, a little background. At the press conference on November 2nd, again, Powell said we're going to continue to raise rates up to a restrictive level. He even went so far as to say, hey, if we did the dot plot over right now from the September meeting, which said, okay, the funds rate's going to 4.6, it would be higher. But he also said, we really don't know what that level is. So what happened in the last 10 days is Jim Bullard from the St. Louis Fed came out and said, well, if we're looking at the Taylor rule, it would be somewhere between 5 and 7%. The Taylor rule was developed by John Taylor back in 1993 as kind of a mechanical calculation to arrive at what the Fed funds should be. It looks at two variables: the economy. Is the economy growing above potential? Right now, the Congressional Budget Office says potential is about 1.9%. Well, what do we know? In the third quarter, GDP was 2.6. And as we discussed last week, the Atlanta Fed GDP now number is at 4.2%. So obviously we're above what's considered to be the potential growth rate of the economy. The other factor is inflation. And there's all kinds of different measures. So you can use the core PCE, you can use the headline PCE, you could use core CPI, or the deflator in the GDP report. So to me, those are the variables, and that's why I think Bullard had a range. But again, the point they're trying to make is, don't confuse us going 50 basis points instead of 75, meaning that our job is done. It isn't done. and this is a guesstimate. So, Bullard brought this to the table, and then Mary Daly, who's the San Francisco Fed president, the San Francisco Fed did a bunch of analysis, and what they looked at was a proxy of Fed funds rate. And Daly's point is that, all right, over the last 8 to 10 years, we've incorporated forward guidance at a much, much higher level than ever was done before. And therefore, as we're communicating to markets that we're going to be raising rates and the markets start to respond, that tightening by the financial markets isn't captured by the current level of the Fed funds rate. The other thing that's in that is quantitative tightening as the Fed shrinks its balance sheet. So her point was that if you look at the Fed funds rate, in September, the Fed funds rate was at 3%. This measure was at about 5.25. The Fed funds rate was between 3 and 3.25. And this was at about 5.2. So the point being is it's about 200 basis points above the actual Fed funds rate. As we know, November 2nd, the Fed raised the funds rate to 3.75 to 4. So what Daly's point will be when they meet on December 13th and 14th is, Bullard's going to say, well, we got a lot more to go. And Daly's going to say, yeah, but if you consider these things, we're up there already pretty good. So that's going to be the internal debate. At the end of the day, it's a moot point. They're going to raise the funds rate at 50 basis points in mid-December. And then the next meeting isn't until February 3rd. So you've got really a long gap there, and there'll be a chunk of data that comes in. Powell said that, one thing that he'll be two things. One is looking at the yield curve. In other words, if the 10 and 30-year bond yields are below where the Fed funds rate or the 3-month T-bill rate, which is obviously the case right now, that, in other words, tightening an inverted yield curve across the whole maturity spectrum. Well, we're kind of there. The other thing he mentioned in terms of, what would be a guesstimate is to compare the core PCE to the funds rate, and that the funds rate would have to be above the core PCE. Well, the core PCE, I believe, was 5.1%, the last reading. So this is going to be the discussion that the Fed has internally at not only the December meeting, but I'm sure ongoing meetings.
And it's going to be it's probably going to be a very heated debate, as you pointed out. There isn't another Fed meeting for another 2 months after this December meeting. So,
yeah, I mean, I think to me, like, this meeting in December kind of puts the chips on the table, and they're debating it. That next meeting is where it's going to get, okay, how much more should we do? Do we need to do? That's where it gets a little bit more challenging, at least from their perspective. But the message, again, to me, in listening to what the Fed members are saying, rates are going to continue to go up a little bit more, but more importantly, they're going to keep them up for most, if not all, of next year. And the economic repercussions of that is we're going to have a recession. Is that really that simple? And again, if you look at this chart and you see the red line is the Fed funds rate, and you can see how the shaded areas, those are recessions. So as you can see, every time the Fed has raised rates, significantly, there's been a recession that quickly followed. Maybe next week we'll look at the unemployment rate and recessions. So to me, the messaging of the Fed is trying to push back against financial markets that want to jump to a conclusion which is unfounded. And by doing that, the financial markets are loosening and easing credit conditions, financial conditions. Right. So the Fed is pushing back because it's no, we don't want you guys to get crazy on us. We want you to understand what we're saying. So, again, that's what I think is coming in the next handful of months is Wall Street, after we get this seasonal rally that's in place over with, I think is going to have to face that music. And my belief is, as I've said before, is I think we're going down to the lows of mid-October, or 3,500, and potentially down to 3,200, which is the 618 retracement of the rally from March of 2020 to January of 2022.
Well, before we get into your market charts, Jim, I just wanted to say, if you guys and gals like what Jim is presenting here to you, make sure you subscribe to the Trader Summit channel so you don't miss any of this exclusive content that we have with Jim. Also, make sure you give them a thumbs up and comment down below. If you have any comments regarding anything that Jim has said, jump in the comment section, get in the conversation. We'd appreciate it. I know Jim would appreciate it. All right, let's talk about the VIX, Jim. You brought this chart up. It's not a chart that you bring up all the time. What do you see with the VIX, and where's the risk here?
Okay. Again, as you know, a number of weeks ago, my expectation was that the S&P would rally to 4,050 to 4,150 as being kind of like, okay, here's the range. And as we've gotten closer to 4,050, what we can see is the VIX at the bottom panel is getting down to where the rallies that we've seen so far in 2022 have ended. Now, we're not there yet. You can see each time there was a little basing that took place with the VIX before it then turned up. So I think there's, a window of time over the next week where the market can continue to try to grind a little bit higher. But this is, to me, an early warning signal that we're nearing, I think, a trading high. And
damn it, Jim. Yeah. Are you telling me right now that Santa's going to bring everybody a bag of coal? Is that what you're saying?
It may not be a bag of coal right away. That may be delayed until like the first quarter. But just from a risk-reward standpoint, this whole rally, again, just like the other two rallies, were predicated on a misconception of what the Fed was going to do. The market rallied from lows in February, March into late March. Oh, hey, the Fed is actually serious about raising the funds rate to 2.5. The rally to August, oh, God, we're in a recession. They're going to have to pivot. And then I think the current one is, oh, good, they're only going to go 50. That's another pivot. So to me, it's just waking up to reality. And so can we spike a little bit higher here? As I said, the 200-day average is around 4,060, just below it. You can't see it off on the right-hand side there, but, we could get a spike above it. Just because if you get above it, you're going to get some of the systemic traders that use the 200-day as a signal generator to go long come in. I just think it's been, over the last 2 weeks, get above 4,009, do a little selling. Get above 4,028, do a little selling, because I think we're getting close. And as we've seen, sometimes the market reverses very quickly and hard.
Jim, if you take this blue line up here, this one that you have up here just above the 200-day moving average, it's actually, you put it down in the bottom and it's a channel. It makes sense, get some of the systematic traders getting long above the 200-day moving average, get smacked right back down at channel resistance or this big blue line descending trend line that you guys see here that Jim has noted. So anyway, you look at it, we're kind of viewing the same thing. Jim, what do you make of the S&P then? So now that we're here, you're just saying lighten up, 4,100 is going to be key. What do we do here?
Well, from the low of mid-October, you see a choppy rally into late October. And it's wave A. This is one pattern that I think seems to fit. Then my expectation was, okay, sell above 3,900. It got to 3,912. I thought we could drop to 3,698 that was just a 50% retracement. So that happened. My expectation then was the rally up to 4,050 to 4,100. What you can see is from that B wave under the 3,698, 1, 2, 3, 4, and I think we're nearing the end of wave 5 of what will be a bigger ABC rally, similar to the rallies we've seen previously this year. So that's why I think the odds are it's time to be lightening up. And if I'm right about what the Fed is intending to do and they follow through, which I have no doubt that they're going to do, that the market is going to have another selling wave over the next handful of months as we really inch closer to weak economic data, and ultimately what that means for corporate earnings.
Well, it's interesting to hear what you have to say about the dollar, because that would mean that the dollar might have a bounce here soon. Is that what you're seeing here on the dollar index?
Yeah, the chart basically, again, I'm not convinced that there isn't another higher high coming over the next 6-9 months, whatever, on the dollar. That's why that 3 is up there. And then the way the dollar declined, you can count it as a 1, 2, 1, 2. And then when the CPI report came out, it was lower than expected. The dollar got slammed. To me, that's a wave 3. My expectation is, since you had a 1, 2, 1, 2, you should get a 4, 5, 4, 5. Choppy as it works its way down to the 104 to 105. You know, there was a high back in January of 2017, just over 103. So my point is, you get under 105, 104 area, you're coming into some longer term chart support, and the pattern, I think, again, 4545. If the top is in, it doesn't matter. You'll have completed a decline, and then there's going to be a retracement rally that the dollar has of at least 50% of the decline from the 114.77 to whatever the low is in the next handful of weeks. You know, could it get up to 108.5, 109.5? Sure. 109.20 was a big number, you know. So as that happens, you know, I think it would be part of the equation where currency traders said, wow, the Fed is really serious. They are going to continue to raise rates, and then they're going to hold them up there. And, you know, so again, bottom line is it's time to be looking after a couple more squiggles on the dollar index for the potential of a rally. It may be 2-3 weeks away.
Got it.
Gold,
well, you know, the gold, I'm going to say, you know, just I've been very underwhelmed by its performance here. I mean, you know, gold has bounced, sure, but really we have yet to really capitalize on that weakness that we've seen in the dollar. So, what do you think about gold here?
Well, that's a great observation, Blake, because given the magnitude of the decline in the dollar, one would have thought that gold would, but from the chart analysis standpoint, you know, we've talked about Javi for about 2 months. Where, all right, my expectation was we were going to get an ABC rally up towards 1750, 1780. And when we got there a week and a half ago, in my Monday weekly technical review, I said, hey, 1770, do some selling, because I don't know what's going to happen next. And it got up to 1774. It's pulled back a little bit. That pattern that I presented is from the high at 2067 in March of this year. 1 down, 2 up, and then a 1, 2, 3, 4, 5 for wave 3. There's ABC as a wave 4. That opens the door to a drop below 1600. And that's why I thought, you know, there may be another $20 or so, $30, where it could get up to 1800, 1810. But then you're going to get a pullback anyway. So selling here and potentially avoiding and capturing some okay profits made sense to me. If the gold follows this pattern, Blake, and does drop below 1616, I think that completes a big ABC from August of 2020. And what that implies is a very significant rally in gold. So, but in the short term, to me, I felt very confident, kept saying it over and over, 1750, 1780. We got there, and it's like, okay, thank you. Now I don't know what's going to happen, but those are the general guidelines.
Well, Jim, I tell you, you know, as a trader, it's always refreshing when you hear traders, say other analysts or economists say, you know, I just don't know what's going to happen here, because, you know, in the markets, that is truly the case. I mean, you a lot of times you have convictions. And then there are other times where you have less conviction, and it almost suggests that you should sit on the sidelines. So kudos to you, Jim. And I want to say it's always a pleasure having you here every week. I know I love it. I know it's a good dose of reality for me. Sometimes as a trader, I can get carried away with expectations of what I might think the market is doing. But you really are a refreshing breath in the markets. So how do I, as a trader, find out more about what you do, Jim?
Macrotides.com. And if you want a recent publication, a weekly technical review, Jim Welsh Macro at Gmail. And I'll be happy to send it out to loyalists of the Trader Summit.
Well, that's a very, very generous offer. So make sure you guys and gals take up Jim on that offer. Jim, have a great remainder of your Thanksgiving weekend. And we'll see you next week.
Sounds good. Same to you, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.